We will now continue with an informative presentation by Mike Langlois. Beginning his career as a financial advisor in 1989, Mike Langlois quickly excelled in the financial industry, earning Prudential of America's Rookie of the Year. In his second year, Mike became Prudential's #1 investment advisor in Canada and has since consistently ranked among the top 10 advisors in Canada. In 1996, Mike created his own independent operation, Langlois Financial Services Incorporated. Mike is a certified professional consultant on aging and a certified health insurance specialist. He is a member of the Elite Wealth and Estate Planning Group and a lifetime member of the $1 Million Roundtable. Membership in this organization represents the top 1% of life insurance and financial services professionals in the world. Please welcome the President of Langlois Financial Services, Mike Langlois.
Well, everyone, I hope everybody enjoyed eating tonight, because it seems like we've been doing it for the last 3 or 4 hours. At least it felt like that to me. Thanks, Brian, for the introduction, and good evening, everyone. And I do have a few topics tonight that I'd like to discuss with you this evening. But as usual, I'd like to take a couple of minutes to give you a little brief update on what's happening in the Langlois Financial, not Langlois Financial, but the Langlois family world. We recently received some news that we weren't supposed to share with you because it's too early, and everybody's been asking me how my son Michael's been doing. Well, apparently he's been doing very well, because we're pleased to announce that Michael and his lovely wife Lindsay are expecting their first child this coming June. And I'm sure this time next year we'll have some interesting pictures to show you on our screen. Now, also in September, we had a special birthday. For those of you that haven't seen our little guy, our Chihuahua turned 15 years old, Tiny Tim, and he's doing well. And in a couple of weeks, we're going to be celebrating another birthday when our grandson Nathan is going to be turning 3. And you can see that Nathan and Timmy get along very, very well. I'd like to make one more personal note that I'd like to take care of, and that is a special hello to some friends of ours, Linda and Richard, who are unable to attend our seminar, but always take the time to watch them all on the internet. And we just want to say hello to Linda and Richard, Richard, please get well soon. Now let's get back to a little more business. Now, most people, the biggest investment decision they're going to make in their lives is the purchase of their home. And that means that for most of us, at some point in our lives, we're going to have to set up and investigate the ability to get a mortgage. And you know the drill. You sit in front of a mortgage specialist who rushes through a brief explanation of all the paperwork you're about to sign, and all you're really thinking about is where you're going to put that big screen TV. So even if you're able to concentrate on what the mortgager is saying, you might not be getting all the facts, and you might in fact not even understand some of the things that you're hearing. You know, there used to be a time when financial institutions you went to, you were automatically offered a conventional mortgage. Tons of paper thrown in front of you, but you had no problem signing them because you trusted that the lender was going to do what was in your best interest. Now, because of the competitive nature of mortgage business today, many institutions are looking for new and creative ways to make a profit. And unfortunately, that's usually at the expense of the client. And in recent years, many institutions have been switching from conventional mortgages to collateral mortgages. And these institutions have chosen this direction because it allows them to advertise lower posted rates and gain greater control of the client. And when working with their clients, they may not explain to you the alternatives available, and in most cases don't even offer alternative options. So tonight I'd like to explain to you the significant differences between conventional and collateral mortgages, and how what might appear to be cheaper at the beginning could end up being much more costly. Now, some of the important features to be aware of when you're considering a conventional mortgage is that they're transferable. They're portable between properties, and the interest is calculated semi-annually. And only the mortgage amount being borrowed is actually registered to your property. And the rates that you negotiate are locked in for the full term. Now, some of the important aspects to consider and to be aware of when considering a collateral mortgage is that they're not transferable and they're not portable. The interest is then calculated monthly, and the full value of your home, and even as much as 125% of the value of your home, can be registered against your property. Rates can be changed in certain circumstances prior to the end of your term, even though you negotiated those rates. And the lender has the right to attach your property to other debt, including credit cards and even overdraft protection. So let's go over some of these aspects in detail. Now, we're telling you conventional mortgages are transferable. So when your term is up, whether it's a 3-year or 5-year term, for example, you've got the option to pay off the mortgage, negotiate a new term, or even change lenders. And the best part about this is that there's no costs or strings attached to these options, and you incur no legal fees whatsoever. But when we look at collateral mortgages not being transferable, that means that when you're at the end of the term, you can only renegotiate that mortgage with your existing lender or pay off the mortgage. Those are your two choices. You can't transfer that mortgage anywhere else. And if you'd like to move to another lender, you're required to re-register a mortgage with the new lender, and you'd be responsible for all the legal costs. Your new mortgage is being treated as if it was a brand new purchase. And because of these restrictions, you have no leverage when you're negotiating that rate with your existing lender. Now, conventional mortgages are also portable. So if you sell your home and you purchase a new home and you like the rate that you have, you're able to transfer the existing mortgage to the new property without any penalties. Collateral mortgages are not portable. So if you sell your home and you buy a new home, you can't transfer that mortgage to the new property. The three biggest issues for this is, first of all, you could end up paying a higher rate than you're currently paying. Secondly, there could be penalties for getting out of the old mortgage. And lastly, you're definitely going to incur legal fees because you're setting up a new mortgage. Now, how are these mortgage interest rates calculated? Well, the effective interest rate that's charged on a conventional mortgage is equivalent to the interest that would be charged on a loan that is paying interest semi-annually. So, for example, if you had borrowed a $100 loan at 10% compounding semi-annually, your effective interest rate is going to be 10.25%. And the effective rate, that is charged on a collateral mortgage is equivalent to interest that would be charged on a loan that is paying interest monthly. And the example here shows that if you had a $100 loan at the same 10% compounding monthly, your effective interest rate would now be 10.43. Now, that doesn't seem like a big difference, but it can add up over the long term, as demonstrated on this particular slide. With conventional mortgages, only the mortgage amount is actually registered to your property, and this is important because this way, if you need additional credit, such as lines of credit and so on, you're able to use the remaining equity in your home as collateral. And having that freedom to choose your lender gives you a lot better leverage in negotiating your rates. But when you look at collateral mortgages, the full value of the home, and even as much as 125% of the value of your home, can be registered to your property. And the problem with this is that you can't secure any other credit from any other lender using the equity of that home. And regardless of how little you owe on your home, you can only go to the existing lender for any additional credit. And they're most likely going to offer you less favorable rates, knowing that you have no leverage. In addition, this could potentially make it very difficult for you to secure car loans and even credit cards with other institutions. And the reason for this is that when they're looking at your debt service calculations, other institutions would consider the full amount of your debt registered, not what you actually owe. And even if you have a good credit rating and low outstanding balances, you could be viewed as having excessive debts. And this could cause otherwise straightforward credit applications to be declined. Now, when you're negotiating rates for a conventional mortgage, as I said before, the rates are locked in for the full term. So if you're locked into a 5-year term at, say, 2.5%, they can't change that rate until the end of that 5-year term. But on the other hand, collateral mortgages, the rates can be changed under certain circumstances. And one of these examples is if you fell behind on your mortgage payments. And I mean, that's something that could happen from time to time. In this situation, the lender actually has the right to increase your interest rate to a higher rate than you actually agreed to. And one last point to consider about collateral mortgages is that the lender can attach your property to other debts, such as credit cards, even your overdraft protection. And this could even include debt that you might have had with that institution before you even signed up for this mortgage. And there's many other things to consider when shopping for a mortgage, such as flexible payment options and prepayment options. So I guess in summary, what I'm trying to tell you is that there's a lot more to consider when shopping for your mortgage than just rates. And too many people, especially first-time home buyers, don't allow themselves enough time to investigate the different aspects of mortgages being offered. And many financial institutions depend on your rushed and uninformed decision to improve their profits. Now at Langlois Financial Services, we offer some of the most competitive rates as well as flexible options for your mortgage needs. And we also take the time to help you understand and make the mortgage decision that's best for you.